welcome all of you to the UTI Mutual Fund presents Swatantra, which is powered by ET Now. It's an education initiative to educate investors, help them with their financial planning objectives. I'm Tanveer Gill. I'm an anchor with ET Now. And our panelists over here are people who have many years of experience in the business of investing and also in the business of advisory. Mr. Jawahar KP, he is the Managing Director of Enhanced Money. Then we have Mr. N. Balasubramaniam, who is the architect of Bala Financial Consultants. And then we have Mr. Kapil Holkar, who is the founder and CEO of Equations. Thanks very much, all three of you, for joining us today. We have a mix of a lot of students today in the audience. We also have a lot of working professionals. Why is it so important to start financial planning at an early stage in life?
Why investment early is that if you invest in any asset class, then if you invest in the equity markets, so equity markets move in a cyclical range. Yeah. If you see that in last 2.5 years, market gives a very good return. But if you go back from 2009, 10, 11, there is not that much return in the market. But an investor who is invested from last 10 years, then his average CAGR is about 16 to 18% annualized. So that is the basic concept, is that you should start invest early and one should invest on regular basis.
Mr. Balasubramaniam, then the question comes in that, if you've missed the boat of starting to invest early, but you've been thinking about it for a really long time, what is the best way to go about it? How should one approach the markets? Should they go directly or via the mutual fund route?
There is a misconception basically about mutual fund. Mutual funds are not financial products. Basically, mutual fund is a portfolio advisor because it gives access to different asset classes. Mutual fund is a very efficient tool wherein you can definitely access yourself to different asset classes. So what happens? A common investor, by investing a very small sum, he can expose himself to very high quality stocks and he can get a very superior return. So that's why I think mutual fund is a very good vehicle.
Systematic investment plans. Do you think that it is the best vehicle right now to access the markets?
This is a very powerful instrument. The power of compounding in mutual fund is awesome. Why? Because the SIP means investing a fixed sum of rupees on a particular day continuously for 12 months and above. So investor is buying unit at each and every level, low level, medium level, high level, high level. For example, 10 rupees face value instrument, you are buying at different level. End of the day, rupees cost averaging would be there. So basically, the SIP is a systematic approach towards your financial goal, a disciplined approach towards your financial goal. So that people can park money in systematic way and continuously by putting into money into that instrument, the ups and downs of the market, people are diversifying, and end of the day, rupees cost averaging will be there.
Yeah, so you're averaging your costs, and it's important because every month I'm sure all of you get a salary in the bank, right? So a portion of that salary, rather than putting it in the fixed deposit, you can put a portion of that directly into the markets via the SIP systematic investment plan route, getting access to the markets through mutual funds. And that brings me to my next question, Kapil. What do you think is the best strategy there in terms of what kind of products do investors look at in this market? You have debt products, you have equity products, you have gold schemes now coming in. What is the best way to go about choosing the right mutual fund for yourself?
Yeah, that is very important in financial planning. And you need a financial advisor for that. See, if a person is earning, say, 50,000 rupees per month, so what an individual financial advisor will advise, one should at least save 15 to 20% per month. Now there is a different asset class in mutual fund industry. Say there is a debt asset class, there is an equity, there is an balance funds. So then first of all, save 15 to 20% from your monthly earnings. Then identify your financial goals. To identify financial goals is the most important thing, because everyone has a different financial goals. Say for me, my child education is important, my retirement plan is important. For Another person, he can plan an say overseas tour or overseas travel holiday he can plan. So everything can be planned according to his financial goals. When he identify the financial goals, then next step to identify the product. What is the product mix suitable for him? For example, if we want to plan for his child education. So if, for example, his kid is 4-year-old, now there is a next for 13 to 14 years will be with him. So he can have a product mix of, say, child education plans are there in industry, some equity plans, and more of his investment in equity asset class. Because over a long period, equity will give a good return, and it will help him to generate a more return than the inflation.
Okay, let me break that down. You know, there are students out here, so I want to cater to their needs as well. Break it down between what would be an ideal product to invest in between the age of 20 to 30, and then between the age of 30 to 45.
Yeah. Between the age of 20 to 30, one should go for maximum of the equity allocation. Equity allocation, diversified equity allocation, mid cap, small cap equity allocation. And between 30 to 40, one can go for 75% to 80% of the equity allocation, and rest of the 15 to 20% of the debt allocation. Debt with the horizon of 3 years or plus.
Okay. Mr. Balasubramaniam, why do we look at fixed deposits as a much safer investment compared to accessing the equity market? So how would you rationalize for all those present out here today, what are the benefits of investing via mutual funds into the equity markets versus keeping your money in fixed deposits? Because both give you returns. It's just about risk-adjusted returns, the risk that you take for the money that you invest.
The thing is, of course, people are very prone to FDs because they generate a fixed type of a return. But we do have in MFs about short-term funds. In fact, we have liquid funds to the tune that whenever you want the money, immediate liquidity is available. And also, we have short-term debt funds which provide better return, a return more than what FDs can give. I'll compare a fixed deposit of 9% with any dynamic bond fund of a reputed fund house. If somebody has invested 1 lakh in FD and he is continuously getting a fixed return of 9%, vis-a-vis in a bond fund, dynamic bond fund, wherein he definitely earns a return of around 10-11% plus the taxation benefit, because he can index the whole investment after 3 years. When you see the return, I feel that he gets more than 12 to 13% over the FD return. So
annually?
Yes.
Okay.
On the 3-year basis.
Okay.
So that's a good return generated, and it's a fixed return. The thing is, the risk is also low over there.
Since this is really an initiative to educate investors across India, since we are in Bhopal and since we are trying to meet your needs, answer your questions, I want to throw open the house for some questions from amongst the audience. So if anybody has questions for our panelists over here, that'd be great.
My question is not about mutual funds. I just heard a new word, SIP, systematic investment planning.
Yeah.
So I want to know that is it a scheme or we have to manage it on our own?
Basically, what is SIP? SIP is systematic investment plan. Mutual fund companies, there are so many asset management companies, mutual fund companies. When you do the SIP, what happens? There is limited, whatever amount you decide, say 500 rupees a month. That amount goes to the mutual fund company. Mutual fund companies have a number of products, number of equity products and balance products. That 500 will be invested in that equity scheme, and that equity scheme invests that 500 rupees in the market. For example, if you want to invest in the shares, direct equities, then 500 will be nothing. It's a very negligible amount.
Yeah,
you cannot invest anything in the 500 rupees. But if you invest through mutual fund, you can buy units, and you can be a that the stakeholder of that.
Be a unit holder.
Yeah.
Okay. Any other questions? Yes, please.
The thumb rule says, as I know, that you must invest in equities 100 minus your age.
Yeah.
Is it to be rigidly followed?
Jacob's theory of financial management says 15 to 45 age group. That age bracket is called accumulation stage. Accumulation stage means one has to go for long-term financial planning. Then 45 to 55 age group. That age bracket is called as reaping stage. One has to go for balance sort of instrument. And the third stage is 55 to 60. That is harvesting stage. Accumulation stage, reaping stage, and harvesting stage. To accumulation stage, one has to go for long-term financial planning. One has to take risk. At any cost, one has to invest into equity sort of instruments. 45 to 55, that is reaping stage, that age bracket, one has to go for balance fund, two asset class, debt and equity. And 55 to 60, normally, you must have retired around 55 or 60 in between. So you suppose your salary was 1 lakh rupees, and in a fine morning, you got your salary as 30,000 rupees as a pension. Suppose you retired from government service. So in that, your basic requirement is to cope up with that gap. For that purpose, you have to choose an instrument where the equity exposure is 15 to 20%.
I'll add one thing.
Yeah, absolutely.
As you said that 100 minus age, that is not very rigid. That is, you need not to follow that. It depends upon a person to person. Say if you are getting good monthly pension, good rental, then your accumulated amount, what you accumulated over a period of 60 years, when you work hard to earn that money, you should park that money and you should do a asset allocation for that. Say 60 to 70%, 60% in debt, 40% in equities. You can do like that asset allocation. That will give a good return because that money is for your next generation. That money is not for you. You leave it for your next generation.
Yeah.
So let it be grow. Don't hand over a 8% yield of money to your next generation because you don't need that money now.
When you go through various mutual funds, it is always a line is printed. Past performance is no guarantee for future. Now, if that is the case, a common man, so many mutual funds are there, so many companies, equity, balance fund, debt fund, so many. How that poor fellow is going to select?
There's a saying that never get discouraged. Even when things go beyond your control or expectations, always remember that winning is not the glory in life. It is always rising whenever you fall. So that happens in share market. Whenever the share market or the stock markets have corrected, but again what they have done, they have risen and they have risen to great heights and made a new high. Over here, I'll put a simple thing that one thing what you should do is, you should have a financial advisor, number one, so that he corrects you what is the cycle. Because there is an economic cycle of 7 years, in fact. Every 7 years, there is economic cycle wherein you will have a one high and a one low, always. But you have to sit with the financial advisor. Over there, our role comes. And over there, what happens, we guide, of course, because this is not an infrastructure theme working now. Now we can go to a banking theme, or we can go to some other PSU theme like that. So a fund manager would be the right person to advise. So always take the help of financial advisor. Investing in sector funds is really risky. That's why we always advise to go for a diversified fund and invest through a mutual fund so that you get the, cost right at less cost and much needed liquidity and good portfolio managers. You have a wide range of products with you. So all these things, this is for a common person. That's why we always recommend a mutual fund.
The thing is, there is a saying, market cannot be taught. It has to be learned. Likewise, in equity market, timing of the market doesn't matter. Time one put in the market matters. So market is always there. Timing of the market doesn't matter. Time one put in the market matters, and stay invested.
Any other questions, please?
From mutual funds, many times we get higher risk and lower returns. But my question for you, that how do mutual funds help in lower risk and higher returns?
There are so many products available in the market.
I also wanted to talk about a couple, the mixed products, where you have exposure to debt and equity within the same fund.
Yeah. So there are balanced category of funds available in the market, where you can invest in 40% of your amount in the debt and 60% or 65% in equities. There are hybrid funds available in the market, where the 15 to 20% in the gold, very stable asset class, say 20 to 25% in the equities, say 20 to 30% in the arbitrage funds, and rest of the debt funds.
This is the same fund, it's a hybrid fund, same fund has exposure to, so it does your job, like you would invest in real estate, gold, equities, it does that job under one umbrella. The fund on your behalf invests and takes exposure to all asset classes in a certain proportion.
It's one scheme and all asset class in a single scheme. So if you invest 500 rupees per month, that will be diversified with all the three sectors.
I think over here I'll add one more point that investing doesn't mean investing simply. Investing means you should know your asset allocation. You have to have some portion in gold, you have to have some portion in FD, you have to have some portion in equity, you have to have some portion in real estate. So you have to cover all the asset classes because one asset class will perform, the other will not perform. Yeah. So the thing is, you want to see that you gain a lot and like what he said, I want to invest but with low risk. So you have to do your asset allocation properly so that you get a good 12-15% return per annum.
I would like to add one more point in this.
Okay.
There's a tax angle also in this all instrument. You know, whatever instrument we are participating into investment into mutual funds. Basically, the equity funds and balance funds are totally tax-free after 1 year. Whatever income you generate out of equity funds and equity-related mutual fund and stocks are totally tax-free after 1 year. And the second one is debt funds, which is taxable. So as per the recent notification rule, it is long-term capital gain is 3 years. After 3 years only, one can go for the long-term taxable gain. And as far as equity is concerned, one can opt for a dividend payout option where the fund house asset management companies are paying dividend distribution tax directly to the government. So before, if you are opted for a dividend payout, so whatever income you are generating in the form of dividend, that's also tax-free. Why? Because it is already tax paid.
That's an important point as well. Yes, sir.
I would only like to know what are the additional tax benefits available to a government servant?
The very good point. Section 80C, earlier there was, pension fund there was separate section. Now everything is under 1,50,000 bracket only. Over and above, Rajiv Gandhi equity scheme is there. Still it is there. This year also it was given benefit where 50,000 by participating to 50,000 in that particular instrument, one can generate 50% of that corpus. 25% further, 25,000 further you can reduce from out of your tax bracket. Over and above, one has to plan for tax efficient instrument. So you choose an instrument where it is tax efficient. You tax-free nowhere you can get, except mutual funds, in balance fund and equity funds, you can generate a tax-free return. All other funds, which is taxable. So nobody can escape from tax.
No,
tax one has to pay.
Even in those equity funds, the holding period is 1 year because long-term capital gains tax is 0.
Sure.
We had another question from the gentleman there.
Actually, being a novice, if I am an amateur, I have just started earnings. I have some savings with me, little bit of that. But yes, I want to start early. I'm in my 20s, and as you said, we have to start early. Being an early bird is much better. So if I want to start early, what are the sections or what are the sectors which I have to think I have to go for, and how can I divide my money into that sectors which get me good returns and mitigate the risks?
Are you talking about investing directly in the markets or via mutual funds?
Via mutual funds.
SIP will suit you the best because I can really bet on it. Anybody, because the thing is, even a small amount invested over the long term, say you have at least 20-25 years of working head, so you can make a very good goal. You can make a very good goal. In fact, any goal, whatever you have, give it a time period, time frame, so that it becomes your perfect goal. And then you start investing from the early stage. Even I'm telling you, even if you invest 1,000 rupees for next 20 years at 15% rate, you would definitely generate a return of not less than 70 lakhs. So that is the potential what SIP has. That is why we all recommend SIPs to the youngsters. And for a starter, SIP is the best. Invest only through SIP, stay patient and be invested. The time in the market is more important than timing the market. Of course, if you are having a lump sum, somebody would have lump sum, need to invest, always go for a diversified equity fund. And give at least 6 to 7 years time, you will definitely make money. Because I have a thumb rule. I say in 10 years, you at least make 4 times in India. Because that's that sort of economy what we have. Because of the demography. Somebody was talking. So we have such a good demography. We have such a youth energy, in fact. So I think our country would do well. It will be, I think, one of the best emerging markets in the times to come. Let us see in just next 2-3 years, you can make a lot of money.
Look, your question is that how to invest that in SIP. So the asset allocation is important. If you want to do SIP of say 5,000 rupees of per month, then diversify it in 3 or 4 sectors. Say invest some amount in large cap diversified fund, some amount in balanced category of fund, some in small and mid cap funds. Because over longer period, the small and mid cap will generate alpha on your returns. So that will help you to generate a good return over a period of long term. And first of all, identify your goals. That is more important. What is your goal? Is your goal is child education, or your goal is retirement, or your goal is marriage, or you want to buy a new car after 5 years or 7 years or 10 years? Then identify that goal. Then according to plan, select the plan, according to select the scheme, then start investing in that and invest in regularly.
Any other questions, please?
My question is that, just you said that what are the benefits of investing in a mutual funds rather than any other?
Why would one not invest in the markets directly? If they have time in hand, if they can do their own research, why not invest in the markets directly? Why mutual funds?
Why mutual funds? If you want to invest directly in equities, you need a big amount. Say, if you want to directly invest in equities, you have to diversify your portfolio. You have to buy automobiles, you have to buy pharma, you have to buy capital goods, you have to buy technology. IT, whatever it may be. You have to make a combined portfolio of every sector. You need a huge amount. If you have a 500 rupees per month, go directly mutual or any diversified mutual fund that will have in pharma, capital good, IT, everything is there. So with 500 rupees of amount, you can participate in the market. But if you want to enter directly in market, you need a lump sum amount. You need a steel nerves, because you have to see the daily volatility. One day you see your stock will be on upper circuit, and maybe after 2 or 3 months you will see it on the lower circuit.
Like what happened between August to now. If you've directly invested in the market, your heart would be
25% of money is eroded from the portfolios. 20-25% money of stocks are falling like anything. So you need a steel nerves for that.
I think with a very low cost, you are engaging the best investment brains or fund managers of the country to work for you, basically, if you invest in mutual funds.
Yeah, that's true. They spend time on your behalf to do all the research and invest wisely.
Yeah. Suppose you are investing 10,000 rupees into a mutual fund schemes. You are not investing that 10,000 to a particular stock. You are investing that 10,000 to different stocks, like diversified mutual fund. Basic industry is there, cement is there, steel, chemical, fertilizer, civil aviation, tourism, IT, pharma. Suppose out of 10 funds, 4 fund is performing, 4 fund is not at all performing, and to end of the day, your risk is diversified. Where in equity market, your risk is very aggressive.
Before we wrap up, together these 3 people out here handle more than 3,000 investor queries and advise more than 3,000 investors. So very quickly, what would be your parting shot in terms of guiding those present out here, our audience members, on how they should invest in mutual funds? Just your parting.
So there is a saying in Hindi, abhi nahi to kabhi nahi. So this is the right time to participate into the market.
Okay, great. That was pretty precise. Kapil?
Invest regularly, do SIP, and stay strict to your goals.
I think this is the right time to invest, and stay focused to your goals, and invest regularly and stay patient. You will always make money.
Patience pays. Thank you very much, all of you. I just want to also add that if you want to know more about this initiative, you can go to beswatantra.com. If you have more queries, you can log on to Twitter, and hashtag Swatantra is the place where you can raise your questions, and those will be answered by a team of experts. Thank you very much.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.